Come visit us. We have free coffee, tea, and sometimes snacks and leftover food for our students. So come say hello, especially if you're here over the summer. So this is our fourth series in the financial literacy workshop program that we've offered this academic year. We hope you've enjoyed it and found it very helpful, very interesting. Before we get started with our presentation, I do want to give a special recognition award to Michael Clancy for volunteering his time to offer all four of these workshops for us this year. So on behalf of the Graduate College, thank you very much. And I have a little gift bag so you can take it home in. All right, so without further ado, continue to eat your lunch and enjoy. We're going to get started with the financial planning workshop, and this is Michael Clancy.
Using the microphone? Okay. Keep eating. Let's make sure this works. As we mentioned, this is the fourth in the series. The prior topics, we did budgeting back in August. We did banking, credit, loans, and so forth around the October timeframe. And we did taxes earlier this year, right at the beginning of tax season. Very boring, very dry, very fundamental type topics. We're going to kick it up a notch today. We're going to do beginner investing, essentially. This is what a lot of people love to jump to investing. We need to solve all the other problems or issues first before we can start thinking about investing. Now, of course, I always love different Ben Franklin quotes. An investment in knowledge pays the best interest. These are the objectives for today that we're going to follow. I'm going to kind of differentiate between savings versus investing. A lot of times you'll hear the terms used interchangeably. I really want to kind of distinctly put them in two different categories. I'm going to spend time on goal setting. People always want to go to, hey, what should I buy? Where should I invest? Things like that. It's like, well, no, we need to have goals first. I'm going to kind of demystify the types of accounts that you're going to hear about. Again, everyone always wants to jump right to, what do I invest in? No, we need to know how, we need to know why, we need to know where before we actually get around to what to invest in. Retirement accounts, we're going to talk about matching contributions, why you hear so much about that, why that's important. And then I'm going to get a little fun with the investor behavior, diversification, and of course taxes, because every single thing you do has a tax component to it. So I'm going to try and tie it in that way. So for savings and investing, what are we talking about when you hear the term savings? We're talking about emergency need money, stuff that you need to keep safe. The term that's used is liquid. That means you have ability to access it without penalty and or a time delay. It needs to be safe. Again, this is we have money set aside to take care of our more pressing needs or emergencies. We can't subject it to risk because the risk, it might be down at the time that we happen to have an emergency, and therefore it's not available. So we're talking about savings, we're talking about things that are safe, very readily available, stability, things like that, very little fluctuation in value. Investing is for much longer time frames. It's not for next week, it's for years down the road, possibly. There is a potential for growth with investing. That's why we're doing it in the first place. We're trying to make this pot bigger. There is the potential for loss, though. So there's that element of risk to it. So when we're talking about investing, we're putting things at risk for the potential of growing them. Savings, we're not taking risk. So that's why I'm going to kind of differentiate the two concepts. Now, savings are things like your bank savings account, CDs, any other type of bank product like a checking account. Money market accounts, whether it's through a bank or through a mutual fund company, are very safe, very liquid, very stable. Savings bonds are also extremely safe. Fixed annuities, I'm going to throw that in there. That's an insurance product. People think about annuities as an investment. A fixed annuity would be similar in characteristic to a CD. There's a time element to it. There's a stated interest rate to it. So they tend to be very, very safe. For investments, we're talking about stocks, bonds, mutual funds, the stuff you hear about on the news, real estate, commodities could be investments, other types of life insurance products. I'm putting it into this category, though legally I shouldn't. I'm putting it there because in the insurance industry, variable annuities, variable life insurance policies will be pitched or sold to you as a form of investment. They can't call it an investment, but people think of it that way. So I'm putting it into that category. And fixed annuities could also be an investment. It's here in that safe category, but you as an investor might be very skittish, very conservative, very nervous, well, that could be your investment, something very, very safe and so forth. So I'm going to put that one in both categories. Now, we need to have goals. Why are we doing this in the first place? I want you to think about those goals in time frames. Are we trying to, well, we talked about before buying a house. If someone is, let's say, going to buy a house next year, we need money for a down payment next year. So we have a time frame associated with that financial goal, being a homeowner. Are we trying to pay all cash for something, whether it's the house, a vehicle, or whatever? We need that money at that specific time. Is it short-term in nature? One-time use? Is it medium-term in nature? I've got a time frame. I want to be debt-free by a certain amount of time. I want to pay for my child's wedding so many years from now. I want to put a child through college even further years from now or something like that. So we need to think about what are those financial objectives in the first place. There's your goal, and we need to put it into a time frame. Is it short-term? Is it medium-term? Is it long-term? Are we providing for our retirement years? I'm much closer to retirement than you guys, so I'm getting closer to that goal. It's no longer a long-term goal, whereas just starting out in your career, it might be a long-term goal, and eventually it's going to become a short-term goal. Now, what does that retirement look like? I've had clients in the past that I used to manage their accounts for them, that their form of retirement was buying into a retirement community. They had to write one check one day, and that provides for their living the whole rest of their life. So it's covering the retirement years, but the use was one time. Versus other people, you might be living in your own house throughout your retirement years, so you have need for spending over the course of a retirement. So that time frame could be a point in time, or it could be stretched out. There's a time frame until something is needed, and then there's the time frame of how it's going to be used. If I'm paying for a wedding, I'm writing those checks kind of all at one time. Am I putting someone through college? Well, I'm writing those checks freshman, sophomore, junior, senior year. Maybe not grad school. So the time frame until that child goes to college could be 10, 20 years from now. But when they're in college, could be 4 years. Or they could get married 10, 20 years from now. And so there's the time frame until it's needed, and there's the time frame of how it's going to be used. So we always need to put a financial goal in place. Anyone have ideas as to different types of goals? I mentioned retirement. I mentioned buying a house, putting someone through education. So think about your own situations. Think about those financial goals you might have going forward. Now you can start to frame the picture a little bit. When would that goal be necessary? And how do we spend money to achieve that goal at that time? Is it a one-time? Is it overtime? Obviously, the longer we wait to get started, the bigger the hill is to achieve that goal. Now, this is where everyone kind of gets confused or skips this step, is types of accounts. I'm going to put the type of accounts into two broad categories. It's either subject to taxes or it's tax deferred and not subject to taxes. A taxable type of an account, any activity inside that account, interest, dividends, capital gains, will show up on your tax return that year and you will pay taxes on it. If you remember from the tax class, we talked about tax brackets, and I had you envision where's that future career going to take you, what income range will you be in, either single, married, things like that. You're going to be paying taxes at that marginal tax rate at that time. Imagine your investment has or declares a $100 dividend, and you're in the 32% tax bracket at that time. You just lost $32 of that dividend due to taxes. Tax deferred accounts, regardless of the activity inside that account, interest, dividends, capital gains, does not show up on your tax return that year. So if you're going to be in a higher tax bracket throughout your career, you want to accumulate assets inside tax deferred accounts so that they can continue to grow without having to pay tax on it every single year. Think of it that way. Now, in a taxable account, you could have a capital gain and pay tax on it. You could have a capital loss and get a tax benefit from it. I talked a little bit about that in the tax class. If it's inside a tax-deferred account and you have a capital loss, it does you no good. You don't get a tax benefit from it that year. Not that you look out to do losses, but losses do happen. So again, two broad categories, taxable versus tax-deferred. Taxable types of accounts are individual accounts that you could walk into, whether it's the credit union across the street, Charles Schwab, Fidelity, Vanguard, any of those companies that you hear about, and you open an account in your name, it's considered a taxable account. It could be a trust account, it could be a custodial account for a minor. Anything that happens in those accounts will show up on a tax return that year. Tax-deferred types of accounts could be through your employer, a retirement plan like like for example, Drexel, we have a 403B. For-profit companies have 401ks, state employers 457s, the federal government, if you guys are looking at a career in a federal government, thrift savings plan, IRAs, these are accounts that you set up yourself, individual retirement accounts. 529 plans are specific to a specific goal. So early on when I mentioned what are those goals that we're envisioning, if that goal is retirement, we're going to use types of retirement accounts for that. If that goal was put my child through college, we're not going to use retirement accounts for that goal. We're going to use 529 plans for that goal specifically and so forth. So we'll get to looking at which accounts make the most sense. Annuities could be used for retirement, life insurance products also for retirement or for estate planning needs. Healthcare savings accounts are a type of a tax-deferred account. The specific use would be for medical-related expenses. So if we've identified certain goals, we've identified time frames, and we're starting to get ready to start to do something about it, then that next decision is, okay, what account should I use that's the most efficient use for that specific goal? Now, I mentioned employer retirement plans like the 401ks, 403bs. That's where you're going to do the bulk of your investing over your working career through your employer. Now, contributions come out of your paycheck. You have a job, taxes obviously come out, but you elect to put a certain amount of money into these accounts. It's done on a percentage, 1% of your pay, 2% of your pay, something like that. It's coming out of your account, generally pre-tax. So if you paid $100,000 and you're putting $1,000 a year towards that account, $99,000 shows up on your tax return. It reduced the income that shows up on your tax return, and therefore pay less tax. So that's called pre-tax. It comes out generally each pay period. So you elect a certain percentage of your paycheck. The amount would come out each time you get paid. $19,000 is the yearly maximum for that. I highlighted pre-tax because there are after-tax versions of these accounts. They're called Roth 401ks, Roth 403bs. Generally, people use the pre-tax version. The money's inside the account. It is a tax-deferred account. So however you invest it, hopefully as it grows over time, inside the account, you're not paying taxes on it. However, upon withdrawal, if it was pre-tax going in, you got the tax benefit going in, we have the tax deferral the whole time. When it comes out, you would pay tax on the amount coming out in the year it comes out. Now think about your retirement. We don't have a job anymore. We don't have wages anymore. How do we pay for rent, food, utilities, fund? Where's that money going to come from? Oh, well, I've got a retirement account. I've built it up over the 40 years. Now we're pulling out a little bit to pay the bills each and every year. You pay tax on the amount you withdraw at the time that you withdraw. That's generally, and you'll see how this works later. Some employers put in matching dollars. So for example, you, the employee, put in a certain amount, your employer might say, great, we'll put in money on top of that. It's usually a formula, 50 cents on the dollar, maybe 100% up to 3% or something like that. So you put in 3%, they're putting in 3%. You're putting in 4%, they're only putting in 3%. So usually there's a formula involved, and what's called a vesting schedule. A vesting schedule refers to, hey, if you leave that employment, how much of that free money do you get to keep? It'll again be a formula, generally after 1 year of service, or 100% after 3 years of service, or maybe it's 5 years or so forth. So there's generally strings attached to it. But again, employers use it as a retention tool. As I mentioned, the Roth version of the 401k, the Roth version of the 403bs, those are after-tax dollars. You're still putting in your portion, 2% of your pay, 3%, 10%, something like that, but it's not lowering your income that you report on your tax return that year. You still pay tax on those dollars, but you pay tax the year it goes in. For the next 10, 20, 30, 40 years, it's still tax deferred. When the money comes out, it would be tax-free. So it's basically the mirror opposite of the pre-tax version. Matching dollars, I'll probably have this on the other slide. Matching dollars are always pre-tax. So even though you, the employee, have picked the after-tax version and you're putting 10% of your money away, you're paying tax on that money that you put away that year. Whatever that amount grew to be over the next 10, 20, 30, 40 years is totally tax-free. Now, the employer put matching dollars in for you. That money has never been taxed. The growth of that money has never been taxed. So when you do finally pull the money out, your portion is tax-free. The employer portion, you would pay tax. But you have these choices. For those of you that know me, I work at the medical school. I work with the graduating, now doctors. They go into a residency program. Their income is relatively modest. They're in lower tax brackets during their training years. And then they have that physician income in their higher tax brackets later. A lot of times I would suggest during their low income years, put money in after tax. Pay at that lower tax rate. Then when they're what's called an attending physician, put the money in pre-tax. Again, they're in the 12 and 22% tax brackets early on in their career. Throughout their career, and they're in the 32, 35% tax brackets. That's when they need the deductions. They didn't need it early on, so they pay the tax early on. So there are some strategies around this. And then in retirement, when they're pulling that money out, they got the deduction at the 35% tax brackets. And then in retirement, they're paying tax at probably the 24% bracket. So there's a little bit of an arbitrage ability there. What else? Let's see. So again, the pre-tax version, we're getting the tax deduction up front, tax deferred during, but it will be taxed upon withdrawal. The Roth version, no tax deduction up front. It is still tax deferred the entire time the money's in, but then no tax upon withdrawal. So that's basically the big differences between the two. Let's see what we got. Traditional, like I said, they come out pre-tax. There are some other little nuances to it. Whether you're still an employee, leave employment, if you take the money out too soon, under age what's generally called 59 and a half, you would pay tax on the money and you would pay a penalty. Again, these accounts are designed for retirement use only. So by taking the money out too soon, the IRS is going to tax it and penalize it. However, once you grow old enough and you're over 70 and a half, the IRS does want you to pay tax on this money at some point. So even if you didn't need it, you're forced to take out what are called required minimum distributions every year. It's a portion of the account must be withdrawn at that point. And that portion becomes percentage-wise bigger and bigger as you age. But you will eventually pay tax on those accounts. Again, $19,000 a year is this year's limit. The Roth versions of the employer plans, again, the money's coming out of your paycheck after tax. There is still a penalty if you tap into that account too soon, but there's no required distribution. The IRS doesn't care. They already got taxed when the money went in. They don't care when you take it out. Still the $19,000 a year limit total. Personal accounts. We have our employment accounts, but you could also invest for retirement yourself in what are known as IRAs, either traditional or Roth version. The traditional is the pre-tax, so it is tax deductible. Same scenario. Don't want to touch it too soon. You have required distributions over 70 and a half, but the dollar amount's a lot lower. Through your employer, you could put away $19,000. On your own, $6,000. The Roth version, or actually, like I said, withdrawals would be taxed. Roth version. One thing with the Roth, money that you put in, you don't get a tax deduction, so that money's already been taxed. This is something that people really don't think of. You can pull out your contribution at any time. It's already been taxed, so the government doesn't care that you're utilizing it. If you take out the growth portion, again, you put in $6,000, let's say it's grown to be worth $8,000. The first $6,000 is your own money coming back to you. If you go above the $6,000 that you contributed, that's the growth portion, you would be penalized under age 59 and a half. There's no required distribution at any age. Again, $6,000 is the limit, but the growth portion would be totally tax-free in retirement. Your portion is always tax-free because you paid tax on it already. The growth portion's never been taxed. However, on the Roth version, it would be tax-free in retirement. Let's see. Yeah, we are contributing after-tax dollars. The Roth account, though, has some income limitations. And what I was looking for, I handed this out at the tax session. I'm going to ask if we could pass this around. You didn't distribute these before, right? You can pass these around. My little, what I call cheat sheet, references this as well. If you're single and your income is under $122,000 a year, you can make a full contribution to that account, that's $6,000. This has what's called a phase-out range. If your income is between $122,000 and $137,000, again, if you're single, the amount you're allowed to contribute starts to phase out. You can't put in the full $6,000, but it starts to reduce down. Once your income is over $137,000, you are ineligible. You cannot contribute to a Roth IRA that year. Yep.
When you say income, is that just from your employer or all sources of income?
It would be the adjusted gross income on your tax return, which would include all sources of income. It could be pensions, farm income, royalties, wages, everything. Very good question on that. The IRS looks at the adjusted gross income number on your tax return when determining eligibility for things like Roth contributions or other types of tax benefits. That little 2-page handout just has basically every financial ratio, terms, phase-outs, tax brackets, anything. So that's why I always carry it around with me. Married filing joint, you can see the income limits are higher. Notice there's not married filing separate. I do a lot of student loan scenarios for graduates, and there could be a case where for a married couple, we have them file their taxes married filing separate for student loan purposes, but as a result, that does impact what they can and can't do with Roth IRAs and so forth. So I always try to bring student loans into this as well. Let's see. Here's what I meant by having the Roth account available to you. There's what you put in, and then hopefully what the account eventually grows to. Again, what you put in is always 100% available to you at any time, no questions asked, no tax, no penalty, no nothing. Other types of retirement accounts, there are exceptions where you're allowed to utilize an IRA or your 401k for, let's say, a first-time home buyer, or to put someone through college, or for a medical bill or something like that, that could help avoid a penalty. Roth IRAs, the contribution, you've already paid tax on. That's why it's always available to you. So picture someone early in their career, you have money in your checking account. You have money in your savings account for emergency purposes, and you don't have any other money. I might suggest, why don't we take some of that savings, throw it into a Roth IRA. If you have an emergency, you can pull the money back out. Now, very few advisors would ever suggest that, because Roths are considered investment accounts. Remember I talked about savings versus investments. Investments are subject to risk. Well, this is still your account. You dictate how it's invested. What if we put our savings account money for emergencies, we throw it into a Roth, but how we happen to invest it is very, very safe. A bank savings Roth IRA, a bank CD Roth IRA, or something like that. That way, what you put in is always available. It's not really subject to risk at all. We're doing that first year of our career, maybe second year of our career. You can say, Mike, I've got $13,000 in here right now, or I've got $8,000 in here right now. I don't need more than that for emergency purposes. Fine. Within the one account, you could leave, let's say, $4,000 or $5,000 very, very safe, and the rest within the same account, invest that. Make that subject to risk. 5 years later, Mike, I'm ready to buy that house. Or my car got wrecked, I need a new car. Well, the account, wherever it is, the Charles Schwab's, Fidelity's, Wells Fargo's of the world, they know how much you put in, and they know how much the accounts were. Call them up. I need $1,000. They always take from the contributions first until all of that is used up. So if we have money in the bank, that was our emergency fund, and we haven't bothered to set up a Roth, I might say, hey, let's just move it over there, because now that money is in a tax-deferred account. 5 years later, we're in a very high tax bracket. We're going to wish we had more of our money in tax-deferred accounts. So the Roth has a nice little feature to it. Again, very few advisors ever talk about it in this vein, because they think, oh, it's an investment account, it's for risk, it's not for emergencies. You can still make it very safe. So it solves both of our needs early on. Does that make sense? All right. I talked about matching contributions. This is the big deal. When you're looking at employment situations, thank you very much for the job offer. What are some of the benefits your company offers? Oh, we have health insurance. Great. We have a retirement plan. Tell me more about the retirement plan. Let's say we have a $60,000 a year salary, and let's say you decide to put in 4% of your paycheck into that account. Let's give it a rate of return. Let's say that account happens to be growing at 6%. Well, that salary, that percentage that you put in really equates to about $200 a month. So that's what's going into that account. After 25 years, that account would have grown up to be $131,000. But what if we got a raise every year? That'd be nice. Again, our salary is going up, so our percentage of our salary that we're putting in follows the raise as well. So really, that account would grow to, or projected to grow, about $175,000. 6% is actually a fairly conservative rate of return for planning purposes. But $200 a month initially, letting it grow with our wage inflation, could eventually get up to be $175,000. Now, what if our employer has a 50% match? You're still putting in your money. The employer's putting money on top of that. In this case, it's $100. So instead of it growing to be $175, it's now $263. Maybe we're evaluating two different job offers. One employer has a match, one employer doesn't. All other things considered, which is a more desirable job. So let the employer help you with this. You might not see this at a smaller firm. The larger, more established firms generally have the benefit packages that are kind of universal, but maybe a startup company would not have something like this. Let's look at higher salary numbers. Again, I work with physicians. After 35 years, again, 3% raise, 8% contribution, 4%, even a lower rate of return, in this case, no match, $1.3 million versus $2 million with a match. So again, are we just ourselves? Are we married? Is our spouse working as well? If I have a married couple, both employed, one employer has a very generous match, one employer doesn't, but the household only has so many dollars total. Maybe we have the employee that has the match fully fund it, the one without, maybe we don't. So this is where we need to look at the employee benefits to say which one do we want to take advantage of. Now I'm going to jump over to investor behavior, but any questions on what I mentioned? You'll see some slides at the end that kind of pull it all together. Investor behavior does play a role. I always like to use little charts. Basically, when everything's doing well, the stock market's rising, everyone feels good, they tend to invest more. And when the stock market drops, everyone runs for the exit. So essentially, they buy high and they sell low. That's not what you want to do, but emotionally, that's what a lot of investors do. I show this slide and people say, that won't be me. Yeah, it will. You guys are all too young for this. This time period here is 2000 through 2013. This was the dot-com bubble, because we're talking about the 90s here. And then it burst. 2001, let's see, 2000 was there, 9/11. So the low was actually after that. Then we have a real estate bubble and burst. We started out in a cash commodity bubble. We're into a liquidity bubble now, and it goes up. It repeats. I've had clients, and I'll show you on other charts. I had a client call me that day. Sell. I can't take it anymore. March 9th, 2019. It's his money. Here you go. Now, what that means from emotional behavior, he wrote it all the way down, was out on the way up. That's just one client. These are millions of people collectively do this. There's what I call investor behavior. Investments return a specific amount. Investors realize a much lower number. The difference is their emotional behavior. So how do we mitigate against that? Have a long-term perspective so you can ride out those ups and downs. And we need to diversify. What do we mean by diversify? It's having multiple things, investing in multiple things. Stocks, everyone hears about stocks. Could be Coca-Cola, could be GE, could be large companies, could be small companies. Bonds, those same companies that issue stocks also issue bonds. Those are essentially loans. People lend them money, it's called a bond, and then they build manufacturing plants. It could be a company, it could be a university, it Could be a state government, federal government, local government, anything like that. There are plenty of entities that issue bonds. It's a type of investment. Cash, believe it or not, for as safe as it is considered an asset class. So between stocks, bonds, and cash is generally how people invest, but also you can invest in things like real estate. Could be an apartment building, could be a medical office building, could be farmland, could be timberland, could be vacant parking lots. There are various forms of real estate that you can invest in. Commodities, used to be hard to invest in commodities, now it's actually fairly easy. We're talking about oil and gas, livestock, agriculture, timber, gold, things like that. The whole point of diversification is having lots of different things. Because sometimes when things are up, other types of asset classes might be down. Again, if you had one thing, you're going to be subject to this whipsaw up and down. If you're investing in multiple things, you're going to have a smoother ride. Now, your returns may not be as good as any one asset class by itself, but the smoother ride, you're more likely to stick with the plan and not look for the exits every now and then. And as managing people's money for a living back in my essentially prior career, it was all about keeping investors calm, keeping them sticking to their plan, and so forth. That's why people used to hire me, because if otherwise they'd be making guesses on their own. Now, to give you an idea of how that works, this chart was, I need to write the dates on this, I guess 2008 through, or actually 2007 through 14. If we look at the green portfolio, that is 100% stocks. So it rides up, there's our bottom. Again, clients panic and get out. The blue is a blend, mostly stocks but some bonds, a smoother ride. Now, I picked those dates so that they both ended up at the same end, but I wanted to kind of prove this point out. But I also need to be intellectually honest to say, yes, the more aggressive portfolio would outperform the blended portfolio over time, but that investor would have jumped off at some point, and they would jump back in, and then off and in, and they would never experience that total return if they can't stick with it. So it's more important to stick with something. Now, actually, I do a bunch of different charts. I always show this one, and I always have to update it the further we go. November 8th, 2016. Anyone know what that date represents? The election. I had a faculty member come into me a couple days before the election, said, Mike, should I sell everything? I'm like, why? Oh, the election, all that. That's noise. There's always elections. We've always had disputed elections. We have people that won and people that lost and everything like that. It's just noise. So since then, stock market's taken off. We've had a lot of ups and downs, but it's actually been a fairly good a period of time. Versus that blended portfolio, again, experiences a kind of a little bit of a smoother ride. This probably goes back maybe a month. So you can see even in 2019, 2018 kind of tailed off in that last quarter of the year. If I asked you before I showed you this, what do you think your opinion of the stock market is this year? Good or bad? Anyone have a sense? Most people are like, I don't know, it sounds probably not doing that well. That's what people would generally say. Really? Why? Because of everything they hear on the news. It's actually a fabulous year in the stock market. But what is the stuff that we hear? So if you're investing, you have to actually tune out a lot of noise. It really does distract investors. So how do we do about doing this? We need to make investments part of your budget. That payroll deduction, that 2% of your paycheck, you wouldn't even notice it. It comes out before you've been paid. That's how you slowly get into it. That's how you make, if we waited and say, no, take your full paycheck home and then once a year write a check and put it into an account, you probably wouldn't get around to doing it. There's always something else we're planning on. There's always a more immediate bill and so forth. We need to make investments part of your monthly budget. Take a balanced approach. Coordinate all your accounts. You have an account, your spouse has an account, maybe we have a separate college fund, we have a separate retirement account, we've got accounts all over the place. A lot of times when I would sit down with investors for the first time, when they used to hire my firm for financial planning engagements, for wealth management, things like that, and I sit down with investors for the first time, again, these are people in their 50s, 60s, and 70s, they would have like 14 different accounts. You're just going to naturally accumulate accounts. You're going to have your workplace account, her workplace account, Maybe we changed jobs. Job A, we left that account there. We're at a new job. We have another one there and so forth. So you're going to naturally get more complex over the rest of your career. You want to consciously simplify as much as possible so that you can control it. You're going to see a lot of pie charts. Really, a pie chart is the easiest way to show a person, okay, what are we invested in? How much or what percentage of our total should be in stocks versus bonds versus different asset classes? You could slice and dice your pie chart as fine as you want. Only small cap international stocks, or only US municipal bonds, or something like that. Or you could be very, very broad. You can invest in the entire stock market, the entire bond market, things like that. A lot of retirement accounts and college funds offer what are known as either target retirement date funds or age-weighted. What those funds try to convey is for someone that is young and starting out in their career, the fund that you pick is set up to be very aggressive because, again, we're trying to grow. And then as you get closer and closer to retirement, it automatically becomes more conservative for you. It's an autopilot type of an approach. Or you could specifically pick each portion and have to tweak it yourself over time. So a lot of retirement accounts, you'll see what are called target retirement date. Like, for example, I'm in a 2035 fund because theoretically I'll retire in 2035. For someone in a college fund, it might be age-weighted. If the child is age 1 through 5, it's very aggressive. As the child gets to the high school years, it gets more moderate. As the child approaches college age, it gets extremely conservative. Why would it do that? Because that's when you're going to actually make withdrawals from the account. We don't want a lot of fluctuations when the child's a senior in high school and the account loses 40% of its value. You know, if when we're hitting retirement age, we want it to be very conservative because that's when people are pulling money out to live on. So you'll see a lot of these age-weighted or time-based approaches. It's a very simple way to go. Where can you do your investments? Pretty much anywhere. Banks, trust companies, brokerage firms, could be Merrill Lynch, Morgan Stanley, could be a mutual fund company like a Vanguard or a Fidelity. You can individually invest with a company directly through what they call their dividend reinvestment plans. There are plenty of advisory firms. I've worked at several. You know, like I said, there's thousands of them out there. E-Trade, there's apps for investments, things like that. You know, what can you invest in? I mentioned stocks, bonds, mutual funds I'm going to talk about in a little bit. Annuities generally are not an investment, but I put them on the list because they're going to talk about them as if they're investments. Limited partnerships, not liquid at all. You know, your money's kind of committed there. Hedge funds you hear about on the news. Horse breeding, art, collectibles, life settlements, tax credits. You know, there's plenty of ways people can invest. I throw Bitcoin on there, and I've had it on there the past several years. I have no idea what it is, you know, but people look at it as an investment. Yeah, so we can get as esoteric as we want. I bring up mutual funds generally because that's how you're probably going to be using your accounts. You're going to invest in mutual funds. What a mutual fund is, it's like a collection of investors' money to invest in a specific criteria. It could be just common stocks, it could be just bonds, it could be just US large cap, it could be very narrowly focused, it could be very broad. You'll hear about passive versus active or index or something like that. What an index or a passive fund does is it has a list of companies and that's all it invests in. There's no discretion. Whether money is coming in on a Monday or a Friday, they simply buy that set list of companies, like the Standard & Poor's 500. You'll hear about that as a list. If it's an active fund, the fund manager, the person who actually decides what to invest in, has discretion. It might like GM versus Ford. Well, both GM and Ford are in the passive fund because there's no discretion, but the active manager could say, yeah, I don't like this company, I like that company. You know, so there's generally two different ways. It's either going to be an index or it's going to be an actively managed fund. You'll hear terms such as growth versus value. What they're talking about there, a growth-oriented company is a company that reinvests money in the next product, the next launch of whatever. Think about a pharmaceutical company. They have a drug, the drug's profitable, they make money. What do they do with that money? They go and research the next drug. Value-oriented companies take money, they sell stuff, they take their money that they make from that, and they give it back to you in the form of a dividend. Think about appliance manufacturers. What is new in refrigerators? Nothing. But they're going to sell more refrigerators next year, and the year after, and the year after. Utility companies. What is new in electricity? Nothing. Those are examples of value-oriented companies versus pharmaceutical would be an example of a growth-oriented company, tech-oriented companies, things like that. Why does this matter? Here, you're getting dividends back. Here, you're not. Is our account subject to taxes? Do we want dividends? Or do we not want dividends? So we can now start to fine-tune what was our goal, what's the right account to use towards that goal, what type of investments do we do inside that account, how do we go about doing it. We haven't even picked anything yet, but we're kind of whittling our way through the decision process. If we have money in our retirement plan, $19,000 a year, and you say, Mike, I've got this extra money, I can't fit any more in each year, it's going to grow up, it's going to be in a taxable account. Maybe I'll do our growth investing in the taxable account, and I'll do our value investing in the tax-deferred account. All the dividends in the world, I'm not paying tax on it. So I can take someone who's in a high tax bracket and make them more tax efficient just by determining what to invest in what accounts. You hear a term market capitalization or market cap. What does that mean? It means collectively that company is worth, if we take all the stock in that company and add it up, how much is it worth? If it's over $10 billion, it's considered large cap. If it's under $2 billion, it's considered small cap. There's about 500 companies that make up the large cap part of the stock market. That's your S&P 500 from number 1 all the way down to number 500. Mid cap from 501 down to 1500. Small cap 1501 down to about 3600. That shows you how many small companies there are. Morningstar came out with what they call their style boxes. So they created a grid. Large cap companies, that's your S&P 500, are either value or growth. Again, General Motors, Ford, Merck, Apple, Alphabet, whatever they want to call themselves, are your large cap companies. Down to number 500. 501 would be your mid-sized companies, mid cap, and then small cap. So again, we can identify where on this box a company is. When I mentioned the S&P 500, if I look at the US stock market as a whole, over 75 cents of every dollar is in those top 500 companies. That's how large those top 500 are, that they're bigger than the whole rest of the market combined. More so, 3 to 1. Costs. Costs are a drag. You're going to invest, you're going to have to pay money to invest. It could be in the form of a commission, it could be in the form of a trade, it could be an expense ratio, which is the cost of running a mutual fund. Obviously, lower is better than higher. Less is more on the transaction costs, and commissions, we hope to avoid commissions. When I was a Merrill Lynch broker, my investors, if they invested with me, had to pay me a commission. When I worked at Vanguard, the clients did not pay Vanguard to invest there. They paid an expense ratio on the funds, but they didn't pay commissions to actually buy the funds. So it's how the advisor gets compensated plays a role in the expenses. And you can do investments on your own, or you could hire someone. Again, if we're hiring someone, that's a cost. What's our return? It's our net return that we live off of. So 2 funds, one with a high expense ratio, one with a low expense ratio, if they both invest in the same thing, theoretically their return should be exactly the same, but the higher expense ratio gives you, the investor, less of that return. And then, of course, there's taxes. It doesn't matter that your investment has a 4% yield and you've got 4% back every year in the form of a dividend. How much tax did we pay on that dividend? You only can eat the net number after taxes. So that's why we want to take advantage of tax-deferred accounts. Everything shows up on the tax return. I kind of hammered that home last time in the tax class. What tax bracket are we in? Picture that career. What are the salary expectations for that career? Are we single or are we married? This is the single tax bracket. So again, where we, that medical resident that I talk about, year 1, they're here. Year 2, 3, 4, 5, maybe 6, they're in this bracket. Then as a future physician, they're in higher brackets and so forth. So think about your own career, think about the compensation numbers that you're seeing and so forth. What tax bracket are we in? Let's see, I probably have it as an example. Oh, there's also capital gains. Well, we buy something, it grows and it's worth something more. Could be, you always pick on Coca-Cola. We buy Coke stock, several years later it's worth a lot more. Well, we need the money. We finally sell it. We have a gain. You have to pay tax on your gain. It's called a capital gains tax. The rate of tax on capital gains is lower than the rates on your income. So that $100 dividend, you're paying your marginal tax bracket rate on, but when you finally sell the stock and have a gain, you pay capital gains based on where your income falls. Imagine not paying any tax on a gain because your income is extremely low. Yeah, so I would do that with retirees. So maybe drop into a lower bracket. I might say, let's start selling stuff. Students that have assets, I'm always trying to sell stuff while they're still in school because they're in really, really low tax brackets. I'm trying to take advantage of that. Now, how do we calculate a gain? Well, we sell it, so we have our sales proceeds. The basis is what we paid for it. The difference is a gain. So what do we mean by basis? Now, basis was your original purchase price plus all reinvestments. When we're talking about stocks or a mutual fund, maybe we put $1,000 into a mutual fund, and every year $10 was reinvested in the form of dividends, and it bought more shares, more shares, more shares. 5 years later, our basis was the original 1,000 plus roughly $50 worth of reinvestments. So that account is now worth $1,200. We sell it at $1,200. Our basis was, what did I say, $1,050. Our gain would only be $150. So again, you need to actually keep track of what your basis is. The brokerage firms do that for you. They didn't used to, believe it or not, but they would keep track of that. This also applies to, in one way, to houses. You know, for example, if you live in your house as your primary form of residence and you bought it 20 years ago and you sell it, it's hopefully worth more than you paid for it. But the basis was the original price plus all reinvestments. The house I lived in, I bought it back in 1999. I put in a pool, I put in an addition, you know, so I've actually put more money into the house. That's all part of my basis. So when I sell it, my gain will not be as big, and theoretically my tax on that wouldn't be as big. You know, so that's what we're talking about with capital gains. What you receive for it minus what you paid for it. Now that could be a gain or it could be a loss. Losses do happen. Short term means you've owned it less than a year. Long term simply means you've owned it more than a year. Long term capital gain rates are lower than short term rates. Now if you have a loss, if you sell, let's say, multiple things. I sold 5 things this year, 3 at a gain, 2 at a loss. They net against each other. It's the net number that shows up on your tax return. You net the short-term versus short-term gains versus your short-term losses, your long-term gains against the net-term losses, and then you net the two together. Now, losses, as I mentioned, do happen. We don't want them to happen. We don't set out for them to happen, but they do happen. But there's a benefit to a loss. People never really think of it this way. Let's say you netted everything out and your loss is $10,000. That year, on taxes, you can use $3,000 of that loss to reduce your income. So it's actually giving you a tax benefit that year. But $3,000 is the most. The rest is carried over to the next year. So we have a $10,000 loss in whatever year, in year 1. $3,000 of it reduces our income for that year for tax purposes. $7,000 carries over to year 2. $3,000 of that offsets our income in year 2, and in year 3, and then in year 4, $1,000. What if in year 2 we have a gain? Well, we had a loss sitting there. That loss offsets our gain. So losses we don't want, but they are useful in investments. Any questions on that? You might read a lot, especially, question, yep.
Earlier you said there was an account that the capital gain doesn't, capital loss, I'm sorry, doesn't account for.
Good question. Any tax-deferred account, maybe we're buying and selling stuff inside that account. As long as it's inside, it doesn't show up on the tax return. So it could be a gain, it could be a loss. There's no tax benefit to the loss because we didn't get to use it. Versus if it was in a fully taxable account and we had gains and losses, they offset each other. The losses are useful. But inside all those retirement accounts, it happens, but we're not getting tax benefit from it.
On the tax deferred.
On the tax deferred accounts. So this would be your retirement accounts, it would be your college plan, your healthcare savings account, anything that's tax deferred. If there happens to be a loss inside it, it's just not useful. You might read a lot of articles of what they call tax loss harvesting. Clients would call me at any time throughout the year, but if it was later in the year and a client calls me and says, Mike, I need $10,000, I would look across what they own and I would sell the stuff that are at losses. I would want to capture that loss for that year So that way, not only could I give them their money because I sold $10,000 worth of stuff, but I realized a loss for them, so therefore they could actually get the tax benefit. Or if I had stuff at gain and stuff at loss, I might sell both, have the losses offset the gains, and then just take the same money and buy something else. So there's a lot of little tax strategies I used to do with clients. Right now it might seem minor, but again, what if we're in those higher tax brackets? And again, I used a $10,000 number. A client could very easily call me up and say, I need $500,000. So bigger numbers, bigger impact. Again, be tax efficient. Let's see. Remember when I said 19,000 was the limit that you could put into a retirement plan through work? What if we happen to be in the 24% tax bracket at that time? You just save $4,500 on federal tax by contributing $19,000 towards your retirement plan. So again, the IRS, the government is giving you advantages here. We want to take it. This is why. So did it really cost you $19,000? No. Again, the tax benefit incentivizes you to take advantage of this stuff. Now, I've come across the concept of tax deductible, tax deferred, and tax free. Generally, you're going to get 2 out of the 3. We either got the deduction going in, it was tax deferred, but we pay tax coming out, or we didn't get the deduction going in, it's still tax deferred, and it's tax free coming out. So generally, it's 2 out of 3. Again, whether it's company plans, whether they're deductible, tax deferred, earnings, penalties under certain ages, is it life insurance could be utilized in specific ways. It's not tax deductible, but the asset within the life insurance does grow tax deferred. I mentioned briefly healthcare savings accounts. If your employer offers what's known as a high deductible health insurance plan, we go get that great job and they say, oh, pick one of our health insurance plans. You need to look at your own situation to determine which plan is right for you. But if they happen to offer a high deductible plan, chances are it's going to be paired up with what's called a healthcare savings account. You're taking your money, putting it into the healthcare savings account. We have that first, second, third medical bill. You're paying from your own account. It was tax deductible going in. If you leave it in there, it's a tax deferred account. And if it's pulled out for a healthcare related bill, it's tax free. That's the only account that gets all 3 tax benefits to it. College funds, what are known as 529 plans, are not tax deductible federally going in. They are tax deferred. If they're used for college, tax free. If we're using our 529 money to buy our house, you pay tax and penalty. We're not using our healthcare savings account to buy a house or retire on. We're not using college funds to retire on. We're not using retirement plan money to buy that house or to pay for college. So we identify the goal. We're committed to achieving that goal. One second. We've dedicated money. We're saying we're going to put it towards this goal. That's when I say, fine, let's pick the right account for that goal. Question?
So if you have a 529, right, but you have, luckily, at the end of the time, enough money to pay for all of your kids' college.
Yep.
What do you do with the extra money? Is it then taxed to use it for whatever you want?
If it's withdrawn, it would be taxed. Good question. When I was stressing about we need to identify the goal first, and then we need to know, okay, I can dedicate money towards that goal, the resistance I always get back from people is, oh, let's say our goal is college, and I say, fine, put money in the 529. Then I always get, what if they don't go to college? Or what if they get a scholarship? Or what if they put in too much? Could I use it for something else? You can tax and penalty on the growth, or leave it. Students might go to grad school. We got a whole room of grad students here. They might go to a grad school later down the road. It's just more years of tax defer. Now, 529s are unique. There are 2 parties to a 529. Think of it, owner and student. Think of the 2 parties. I'm the owner, my child's the student. I use it, don't use it. Maybe they go to grad school, maybe they don't. Maybe they get a scholarship, maybe they don't. Maybe they'll have grandkids at some point. I'm still the owner, they're still the student. Fine, they don't use it, the account is still growing tax deferred. I have grandchild number 1. I move son out of the way and I put grandchild as a student. I'm the owner. I can control that account that way. I just got 2 more decades of tax deferred growth on that account. So it's not the end of the world. It's not the end of the world. However, if you said, push comes to shove, I need money for whatever, this is the only account I have, yeah, you can use it. Tax and penalty because it wasn't used for college. It's only taxed and it's only penalized on the growth. You put in 5,000 and it's worth 10, you take all 10 out, you're only taxed on the 5,000 of growth. You're only penalized on the 5,000 of growth. Because the money went in, you already paid tax on what went in. You're never taxed and penalized on your own money. So people think, oh, I have to pay penalty on the whole thing? No, just the growth. Healthcare savings accounts, same thing. If I take that money out and I don't use it for a healthcare bill, tax and penalty on the growth. So there are various types of accounts. We need to identify the goal first. We need to know our budget. I really didn't bring that up here, but you have to have the budget in the first place. It's all well and good for whether it's politicians or the Wall Street Journal or Money Magazine to say, you should do this. No one should ever say that. You can do this is the right way to say it, because can you? Do we have the budget? It's our first career. We've just moved across country. We have to put a down payment on that apartment. We're paying for rent. We have a car payment. We have credit card bills. But then someone's chirping at it and say, oh, you must do this. Like, no, you need to pay your bills first. We need to have enough money that we can set aside towards a specific financial goal. Then we go about it the most efficient way possible. I mentioned it as employee benefits all the time. Obviously, your health insurance premiums that you pay, that the IBX, Blue Cross, whatever, it's coming out of your paycheck pre-tax. Flexible spending accounts, FSAs, you're going to see that. Those are specific for one of two uses, medical or child care. Those accounts are a use it or lose it. So if you're putting $1,000 a year into that account, you better spend $1,000 that year. Some plans allow you to carry over $500 into year 2, but that's the most you can carry over. So anyone here with children? Just wait. Child care expenses are a very predictable number. You know exactly how much daycare costs. You could filter that daycare amount through your flexible spending account, get the tax deduction, and then spend it immediately on child care that month. When my kids needed braces, we knew exactly how much that was going to be because the orthodontist tells you, oh yeah, that looks like $3,800 in that first visit. So we filtered it through a medical flexible spending account. They didn't need braces year 2. We just did it the one year they need it. And I've had people say to me, oh, I'm going to get LASIK next year. How much does that run? Oh, $1,700. Why don't you sign up for a flexible spending account? You were going to pay the $1,700 anyways. Run it through that. You get the tax deduction for doing that. And there's the money to pay for the bill. But you're only getting LASIK once. So you can do it one year and not do it the second year. Healthcare savings accounts are specific to high deductible health insurance plans. So if we're picking that PPO, that's probably not the high deductible plan. If we're picking that HMO, it's probably not the high deductible plan. But if we happen to pick the high deductible one, your employer is going to offer a healthcare savings account for you. They might even put money in it for you. Because that high deductible plan is a lot cheaper insurance. The employer's saving money, you're saving money. So they might actually put a little bit of money in here to help you with it. Let's see. I mentioned about the flexible spending accounts. Again, it's a way to get the tax deduction without having to itemize to do so. It needs to be a routine or predictable number, and child care generally is routine and predictable. Healthcare savings accounts, I've hammered that home a little bit. So why do we talk about all this stuff? Let's look at a specific scenario. Someone who is contributing the maximum to the employer retirement plan from a hypothetical age 26 to 65, $60,000 a year income, 3% raise a year, 40-year career. Okay, not the maximum, but let's say they put 4% contribution in, or no, a 4% contribution rate. They happen to be in the 22% marginal tax bracket, and we gave a very conservative rate of return of 5%. In retirement, a lot of financial planners, they spend a lot of time talking about safe withdrawal rates and all that sort of stuff. The consensus is, in retirement, you can withdraw 4% of the asset account, of the value of the account, year 1, and then you inflate the dollar amount that you withdraw by a rate of inflation. So 4% year 1, and then you take mathematically a 3% higher number. So it's not 7%, it's whatever 4% was in dollars, and then inflate that dollar amount by an inflation rate. So what are we looking at? Years 26 to, what did I put, 95 or 96 as date of death. The red is how much we're putting in every year. Notice the slight curve. That was our wages going up by a raise every year, so the percentage that we're putting in mathematically is larger each and every year. The account value is the blue bars. So at that 5% rate of return, the account value is growing. Why I used 5%? If I had said 8%, which is what the most planners would use, very few times do you get an actual 8% rate of return. One year it might be 16, another one might be 2, next one might be -7. On the whole, it rounds out to be a 6 to 8%. So I went really low and said, let's use a straight line 5%. So the account value would grow to be about, or no, let's say $60,000 a year salary, 4% contribution rate meant we put into this account $180,000 over our career. We saved $39,000 of taxes by doing so. 30 years later, or over the 30 year of retirement, again, we retired at 65, passed away at 95, 96, we pulled out over $1 million. Again, we don't have a job anymore. Once we retire, we stop making contributions, but we have to pay our bills. This is what everyone is working to without really thinking of it in a graph form. I'm doing this through my retirement plan here. Your parents are, friends, neighbors, people that are already into their careers. This is ideally what we're trying to do. We're trying to plan for those decades when we don't have a job. Now, this was just one person putting money in. What if we waited too long? What if we didn't get started soon enough? There's the time value of money. Obviously, the critical mass does not get as high, and the amount we pull out isn't as much. What if we have matching dollars on that account? We're still putting in the exact same amount, $180,000. We're still benefiting from the tax savings, but the employer is helping juice that account higher. So again, we're evaluating 2 different jobs. All other things considered the same. One has a fairly generous match to it, the other one does not. If we can envision staying there throughout our career, this is where the match really pays off. Any questions on this? This is really the whole ballgame. This is really what everyone is kind of working towards. So, go back to that. Thoughts? Questions? I didn't do that good of a job. Come on, there's got to be.
When you're planning for retirement, do you factor in Social Security or other kinds of income, those types of incomes?
You should. You shouldn't factor that in to change how you would invest. But again, this was just one account, one person, single their whole career. What if our spouse also has a career? Are they doing the same thing at theirs? Do we also have Social Security? I'm going to retire. I think my Social Security full retirement age is 67. The Social Security system is projecting to give a reduced benefit right around the time I retire. So whatever projections I get now, I got to assume I'm not going to get 100% of that. So my plan is to spend it all before you guys need it. But from a planning standpoint, when I used to work with clients, we would look at income, we would look at career expectations, we would look at their budget to plan out what is, this, let's say, $100,000 a year lifestyle. What is the equivalent? How do we maintain that lifestyle in retirement? I used to work with a lot of old people, and I would see a 3-decade type of retirement. In that first decade of retirement, they're actually spending more than they did just prior to retirement. They're still healthy. They still have 2 cars, maybe a country club membership. They're at home all the time, and they're looking, I really want to replace this carpet. I would love to put a porch on the back. We'll do this with the grandkids. Then we go to the second decade of retirement. We go from 2 cars down to 1. We give up the memberships. We're done fixing up the house. And then we get to the third decade of retirement, and it's health related. Are we aging in place? Do we need to put a ramp on front? Do we need a visiting nurse? Things like that. So retirement is really hard to plan. But we have to say, what's our lifestyle now? How do we maintain that lifestyle? We have to inflate that. So again, we're trying to race to get as much as possible so that we can plan for those years. Social Security would factor in any type of employee benefits, such as, is our health insurance being provided? Are we a traditional pension eligible? Things like that. But we have to keep an eye on Social Security. The government has not made any changes to that program probably since the Reagan administration, when they kind of changed the full retirement ages. So over the next 3 decades, I expect there to be many changes to the program to keep it alive. One could be means testing, others could be pushing out your full retirement age to a 69, possibly. You only pay into Social Security on what they call the Social Security wage base. That's one of the numbers in that sheet I gave out. So, and again, I don't quote me on the number. You only pay Social Security on, let's say, the first $117,000 of your income. If you have a $200,000 a year job, you don't pay Social Security. You don't pay into Social Security on those dollars above that 117 or whatever the number is. So elections matter. So when politicians talk about Social Security, you have to dig in. What are they proposing? How are we going to keep this program going? But good question. I know there was other questions. Yep.
You were talking about investing in an account.
Mm-hmm.
So if you have like an IRA with your bank or something like that, you can then take those and tell them where to invest it or something, or
Correct. When I talk about accounts and things like that, you're still the investor. You're the owner of the account. So you have to make a choice. That retirement plan that your employer offers you, let's call it a 401k, 403b, they're going to give you a list of funds to pick from. It's up to you to pick from. A lot of employers, since a lot of employees never get around to making a choice, they'll pick that age weighted for you based on your birthday. Because they feel that, okay, we're taking a shot in the dark and it's appropriate for your age. But you have control over the account. You can pick and choose amongst the choices in that plan. If you set up a taxable account at, let's say your employer plan is with a company called Fidelity, and your employer says, here's 20 funds we're going to let our employees pick from. You go to Fidelity separately, and you walk in the door and say, I want to invest, you've got hundreds of choices. So the employer plans, the 529 plans, they generally limit it to a certain list. On that list is going to be very aggressive choices as well as very conservative. They always make sure they have a little bit of everything, because you might be more aggressive, that employer or the employee that's been there for 40 years is closer to retirement needs a more conservative choice. So they always give you a range, but it's up to you as the investor. You can do it in your IRAs, you can do it in the college plans, you can do it at the retirement plans. Once the account's open and the money's in, that's where the decision comes as to how. Do I go with stocks? Do I go 100% stock? Am I aggressive? Is that retirement goal further off that I can withstand the ups and downs over the next 30 years? Or is that kid going to college next year and I need it to be more conservative and so forth? Yep.
If you're in the situation you mentioned where you have essentially retirement accounts from previous jobs that you've left, can you roll them into another more recent retirement account?
Yep. No. Excellent question. And you touched on the lingo, rollover. When you leave an employer, let's say I retire from, I had actually a coworker come in to me yesterday and say, hey, Mike, I'm retiring. I'm like, yeah, cool, let's talk. 5 options. You can leave the retirement plan where it is, as long as it's over a little bit. Like if it's only $800, they might say, no, here's a check, take it. But as long as it's over a certain amount, you can leave it there. You can laterally move it to your next employer. We go from employer A to employer B. Employer B probably has a plan. You can move it into that if that plan allows for an incoming transfer, and most do. Third option is roll it over. You're going to hear that term in the news called a rollover to an IRA. You're basically taking it from an employer-sponsored retirement plan and you're moving it into your own personal retirement account. And that could be at Wells Fargo, it could be at Charles Schwab, it could be wherever you want. It's up to you. Fourth option, you could convert it to a Roth. We're taking pre-tax money and we're moving it to a after-tax type of retirement account, which means that year you have to pay tax on it. Now, maybe we're going from job A to job B. We're now at a higher tax rate. Do we really want to pay tax in that year that we're working? Probably not. But it is an option. The fifth option, no one ever really talks, is you could cash out and spend it. That's always an option. It's just an 800 number away. It's the worst option, but it's always an option because tax and penalty at your age. But it's always there. If a student comes into me and says, I've got $18,000 of credit card debt, I'm like, we're biting the bullet. We're liquidating that retirement account because I need to get you into a better financial footing. If that's the only money we have, yeah, we'll take it. So I could, if we have an extreme example, justify paying the penalty and so forth. Yep.
So one of the things that, when I'm just kind of looking at this, there's tons of companies to invest in, like you said.
Yes.
Ways to do it. One of the things I kept coming across was, like you said, costs are a real factor to consider. Like, have someone manage it, or you mentioned expense ratios versus commissions. And I was just wondering, how would you recommend going about choosing, like for a Roth IRA? How would you
A lot of times, I look at simplification. Let's say we're employed. For example, here at Drexel, the retirement plan, we have three choices. We could be either with TIA, CREF, Fidelity, or Vanguard. I happen to be with Vanguard. If I was using that through my workplace, I might say, I'll go to do my personal investing also at the same company, just to keep my life easy. I mean, that could be one criteria. If one company is generally more expensive than the other, the insurance-oriented type companies, we're talking about Transamerica, MetLife, Prudential, companies like that, they have a higher cost structure to them. So their investments are generally going to be more expensive. And if they're more expensive, over that same 30-year career, we're not going to earn as much if we have to pay all those expenses that whole time. The Merrill Lynch's, Morgan Stanley's of the world, I used to be a Merrill Lynch broker, are what are called full-service companies. They'll do everything for you, but they're going to charge you full price to do so. Versus the Charles Schwab's, Vanguard's, Fidelity's of the world are what are known as self-directed companies. You tell Vanguard what you want to invest. Vanguard's not telling you what to do. You're telling Vanguard. You're telling Charles Schwab. So the cheaper investments are the self-directed ones, but then again, that's going to be a little bit more maintenance on your end. You got to know what to invest in and how you want your accounts to set up, because you're the one that has to tell Charles Schwab, yeah, I want 20% of my money in this fund, that fund, that fund. Because Charles Schwab's going to say, here's 3,500 funds to pick from. Again, they're putting the onus on you to research what you want and so forth. Now, the self-directed types of companies, the Vanguards, Fidelity, so forth, they put a lot of effort into what's called investor education. They'll have plenty of brochures from what's a stock to how to invest or what's diversification. Like all the stuff I went over, they have brochures to cover that. So they help investors learn so that they become better investors. I try to keep it simple. If we're using one company, let's use that company for all of our needs. This is my own opinion. I don't like banks for investment purposes. They're good at banking. For investments, they tend to be a little bit more expensive way to invest. Insurance companies good at insurance, so they tend to be very expensive on the investment side. So I would say, okay, fine, have our insurance with certain companies, have our investments with specifically an investment type of a company. Just because they tend to do one thing very well. It's when they get into multiple types of financial services, you're going to be paying a cost to it. Other thoughts? I'm not sure if I put my contact information up here, but anyone that has questions can always shoot me a note. Yeah, there it is. I'm at the Queen Lane campus, and generally I work for the med school, so my client base is the med school. But for these types of topics, I'd rather you hear it from someone like me who's not selling you anything than the insurance agents and the brokers and things like that. Anyone here have bank accounts? I'm assuming you all do. Have you ever noticed when you go into a bank branch, and you probably don't go into a bank branch much these days, anyone behind the counter, that's the FDIC insured checking, savings, CDs, things like that. But a lot of times, if you have enough on deposit, they're going to say, oh, let's go sit with Mike there across the lobby. You go across the lobby, that might be an insurance salesman, it might be a broker, maybe it's not the FDIC insured bank anymore, even though it's within the same lobby. So banks, for example, I have enough because I have my kids' accounts, my wife's account, everything all at PNC, for example. I got a little card in the mail the other day say, hey, we see the amount you have in there. You should talk to our private client group. And I'm just like, recycle. Because they'll be marketing investments to you and so forth. So banks, they get away with that. It's all one building. You have the FDIC insured safe stuff, and you don't know what you're getting into. And again, I'm not maligning banks. I give them credit because they offer all the services you could possibly want, but you need to know who you're talking to and things like that. All right?
I have one more question.
No problem.
Can you speak to what you would prefer for somebody who's younger, who has low income, to prioritize? Is it most important to, number one, build up an emergency fund, but then after that, do you start tackling retirement, or do you go ahead and start building up different investments for
Excellent question.
property?
Excellent question. It's like, how should you approach this? I'm going to assume everyone here is broke. I'm going to assume everyone here is early on in their career. What are some of those goals? Are we married? Do we have kids? Do we want to be a homeowner or something like that? Remember early on I was talking about different time frames. Yes, you do need an emergency fund. The graduates I work with are going into residency programs. They're 100% employed. They don't really have the risk of being laid off. So I might not say keep as much cash on hand. A lot of rules of thumb you'll hear is to say have 6 months living expenses in something very safe and liquid and all that. It's hard to accumulate 6 months of living expenses when you're starting out broke and into that first job. Are we here in Philly? Are we in a rural location? Are we in Boston? If you guys are from the New England area, imagine rent in the Bay Area in California or Boston or so forth. That's a significant chunk of your paycheck right there. You're probably going to have an employer with a retirement plan. We want to take advantage of those matching dollars. And remember the numbers I use, 3% of your pay, 4 or 5%. I would suggest let's take advantage of that, maybe up to that 5 or 6%, whatever they match. The rest of your dollars in the emergency funds and things like that, what are our goals? Well, I'm living at home, I've got extra money, I could put it away into a retirement account, or I'm trying to buy a house 2 years from now. If we need the money that soon, we're not investing it. I can't have that money subject to fluctuation. We go to buy a house and it happens to be down. No, we need that rock solid safe. But if that house is like, oh, I'm going to live in Manhattan, I'm not buying, I'm going to be renting, easily throughout my career. Fine, that goal is not one of our goals. What's the next goal we're looking at? Are we starting a baby fund? Are we looking at retirement? So it really is goal oriented. If we have enough of our budget to do both, do both. Because again, I'm not trying to sacrifice one goal over the other, but if you can elaborate what are our goals and our priorities, then you can very easily determine where should your budget go. Some of it's going towards housing, food, personal, maybe student loans, maybe not. Then we could say, yep, I can allocate 10% of my money towards retirement or something like that.
Could you elaborate on what the threshold is for what you characterize as a safe amount of time to just keep it in your savings account versus time where you should invest it?
Again, this is shaded based on the audience I work with, being future physicians. I would look at your monthly bills. Rent, car, transportation, food, student loans, insurance, maintenance costs, fund, personal, whatever. Let's say that's $2,800. I want everything on auto pay because I don't want to wreck our credit because we forgot to pay a bill. Or that bill's due on the 10th of the month, I don't get paid to the 17th of the month type of thing. So I want everything on auto pay. I would suggest if our monthly bills are, let's say, $2,800, that we have $3,500 in our checking account. So that way, whether the bill is on the 5th of the month, the 15th, the 23rd, I know there's enough there to cover it. Everything else would generally be in your savings account. At that point, 3 months of living expenses, I think, in savings. Now, if our car is very reliable, we don't foresee needing a new car anytime soon, we're not saving money for a down payment on a house, I could parse off some of that savings into that Roth and keep the Roth very safe. So we have 1 foot in retirement, we have 1 foot in near term. We get through year 1, we get through year 2. Now we have enough in our savings that I can make that Roth account, instead of it being very safe, very risky, very aggressive, trying to grow it. That's how I'd slowly ease into it that way. But again, think of your budget, think of how much it costs per month. Is there anything within 12 months that we know? Oh, I'm going to Europe at Christmas. I need to save up for that airline flight or that deposit, or I'm attending my friend's wedding or whatever. Yeah, we have to set those dollars aside. So any bills in the next 2 years, we need to set aside, one-time type bills, like a trip or something like that. Anything beyond that, I would say 3 months of living expenses would be good for someone starting out in their career. Other thoughts? Sandra always has one question.
Not this time.
Not this time, all right.
That was a lot of information.
There we go. All right, well, you guys have been great. Like I said, feel free, shoot me a note, say, hey, Mike, I attended that class. Could you clarify this? Or read this, or my mom and dad are saying this. Like I said, I'll tell you, here's what it is, here's what it isn't. Here's where it's useful, here's maybe where it's not. Things like that.